Jeff Bierman's the next contestant on TheoTrade. Yeah, how you doing?
You can call me Mr. Freeze.
Oh, come on. Everybody else is suffering too. I mean, today it's only going to be 66 degrees here in Scottsdale. You don't even know what it's like down in 66 degrees in Scottsdale. Oh man, I'm at least avoiding right now the full-blown flu. Okay. It's like a war zone in my house right now, Jeff. It's horrible. There's three kids, they're all down, they're all on the couch. Okay. There's blankets everywhere. It's just brutal in there, man. I'm not
Check
going
into a
back.
hotel. Check into a hotel. Check it. Stop whining. Check into a hotel.
Really? Yeah, my wife would love that. Yeah, leave the house. Leave the house. If I leave at this point, I'm never coming back. There's no reason. What are you at now? Have you gone from negative to positive in temperatures there in Chicago?
Well,
No?
it's eight. It's about 8 below now, but with the wind
Oh, it
chill, it's
is.
about 18 below.
Actually, it says feels like, can you see that? I can't even see it. Feels like negative 22. Okay.
Yeah.
Yeah, that's Chicago. Feels like negative 22. And you're actually like in the loop there too. That sucks. Ah, well, I'll be thinking about you. It's a nice cloudy day here. I'll be thinking about you, and it'll be 66 degrees here. By the way, I didn't even see it hitting freezing for like the next like 8, 10 days in Chicago. So I really don't miss February, January, Chicago. That's funny because I used to always get called in a ton to Chicago in February. I hated February
Oh,
there, man.
worst month ever to show up at this place.
What are you covering today?
Oscillators, how to tweak your settings to get the most out of your trades.
Well, you can tweak my oscillator anytime, big guy. Look, I'm just happy to be out of the house right now. I got to go back in there in a minute. Jeff, it is all yours. Feel free to grab the screen. I got to hop. I got to go check on a couple of kids. Okay. Again, I don't need a doctor. I need an exorcist at this point. All right, ladies and gentlemen, for the next hour, Jeff Bierman.
All right, let me kick this off by saying good morning. Well, it depends where you are in the US. Good morning, and welcome to the second hour of TheoTrade. I am Professor Jeffrey Bierman. I'm broadcasting you live from Chicago, and today is Friday. Oh, thank God it's Friday. It's January 23rd. It's 2026. And man, we are in the dog days of winter here in Chicago. And as you can see, I'm wearing a shirt. I'm wearing I bought this when I was in Quito, not Quito, but the Otavolo market outside of Quito when I was down in Ecuador. It's a llama warm type of sweatshirt. My God, like if I could market these and bring them up, I'd be a billionaire. So good morning to the usual suspect. Hello, Judge Smalls. You're back around. Trader Tom. Who else is out there? I always see Kevin Preston Stinger. Hey, Rosario. Rosario, you wouldn't want to live here. It's horrible. Okay. You could spit and your spit freezes when it goes out. That's how cold it is. And the irony is, hey, Doug and Chris, the irony is there were two people outside that were running. They were running in this weather. Oh, you talk about like commitment and mental illness. You don't want to run in this weather. Like this is nasty, nasty stuff. All right, without further ado, we're going to get into the second half and talk about oscillators again. I'm going to walk you through how to adjust the settings and tweak certain things so you basically better get sensitivity of trigger, entry and exit. The other day, I tweaked my model. I wanted to get the hell out of that Wells Fargo because I was behind by $3 or $6. I came out ahead because I tweaked the oscillator. It hit the condition out in the trigger I was looking for, pulled it off, got it. Stock bounces $3 within seconds after I covered it. It's not good timing, people. It's understanding how to tweak an oscillator. All right, let's not get into this. Let's move forward. Let's talk about today's topic, today's theme. You don't know where I'm going with this. Everybody, look at the word on your screen now. Anti-climax. You've heard the word anticlimactic. You've heard the term, this is the climax. This is the end of the whole movie. It's the climax. It's the ending. Okay. I'm not saying this is the end of the bull market. That's not where I'm going with this. You got to understand the definition of anticlimax to appreciate what I'm telling you. You perma bulls, you're not going to win this one eventually. Anticlimax, by definition, according to the Literary Devices and Collins Dictionary, is a rhetorical device or a rhetorical expression that creates a disappointing or ludicrous, and this is ludicrous, we're in mad times in the market, a ludicrous effect or disappointing effect by contrasting an important idea with a trivial one, okay? More or less, okay, what it comes down to is that there are two types of anticlimax. The first one used in narration, such as the anticlimax about an overall plot of the story, and the second one is a figure of speech which might occur anywhere in the story. But the idea here is when employed, it devalues the subject matter. People, I know you come in here every day, and I love Gianni and I love Corey. They're like really nice guys, and they keep calling for buy the structure. Okay, I get it technically. It's just the call buyers come in every day and they defend me and they lift it up. Okay, I've been around here longer than all of you have. I see it every day. I live and die by this. I just don't care. For me, you have to pick up on subtle, okay, clues that help you understand the palpable background of what's happening and get just beyond charts all the time. But I will bring charts into the mix. So what I mean by that is this, and I'm going to go through each one of these earnings here. If you've been paying attention to earnings, the financials, okay, they're already reported, all of them, Goldman Sachs, Morgan Stanley. Now you're moving in sequence towards a technology. We're moving in that roundabout way, in that circular fashion of getting to each sector. What have you noticed, all of you, about every single one of these earnings reports? They're not very good. And not only are they not good, there's no guidance going forward. Nobody's raising guidance. Nobody, okay, except one. And we'll talk about that because that's where I'm positioned, okay? I'm positioned in oil. Told you, Gianni. I'm sorry, Gianni. It's going higher, okay? The idea here is read the tea leaves and not the candlesticks. Pay attention to the fundamentals and the reaction of stocks. When stocks report and they gap higher, let them go. When stocks report and they can't move it higher, you have a problem. When stocks report and they sell off and blow out, you got an even bigger problem. We are in a topping formation, people, not just technically, but we're in a topping formation fundamentally. You're not getting companies to raise guidance. A lot of these companies are either reporting in line and they're missing barely. It's not the end of the world. But given the fact that the S&P is at a 39, a cap PE, a cyclically adjusted Shiller PE ratio of 39, which is the second highest in history, you have to understand there is no margin of error here. If that dunderhead Powell weren't cutting rates, all of you would be crapping a chimp right now because we're way down. He cut rates 3 times to stabilize and provide a shock absorber to these bad earnings reports or these humdrum and humble earnings reports. So let me show you technically what my setup looks like so you understand where I'm at, and we'll come to the macro players. Now, this is what Don and I call the vol box. You're in a flag formation box, okay? Here is the flagpole, and here is the box itself. You're just in a sideways lock box, okay? So you're trying to move yourself higher. But to get through that, you're going to have spectacular reports from technology. You're going to have spectacular reports from cyclicals like Deere and Caterpillar. You're going to have blowout earnings from the largest sectors. It's the smaller ones. The energy, it's not going to bring that up. It won't, okay? I'm going to report for REITs. It's not going to impact that. REITs make up 2% of the S&P. You're going to have the heavy hitters that carry the load to drive that higher. The setup is not there technically, nor is it fundamentally. So be aware of what I keep telling you. We'll get to the individuals. GE reports, the earnings basically were not very good. They didn't guide higher, period. There's an earnings report. They should be carrying it. Not moving it up, people. Not a good sign. You're getting a lot of these companies reporting and saying, here's your biggest of biggies. Reporting better. It's down another 5 today. Oh, they reported, they beat, and the market basically crapped all over it and sold it. This is what you're not seeing. Forget about that stupid S&P. Look at the individual stocks, because it's not a stock market, it's a market of stocks. And eventually, when these things start to break, then it all just implodes unto itself. All it will take 20 or 25 stocks. JP Morgan is one of them, GE is another. They one by one, just pick them off, and the market just starts going down. You're like, what do I do? Okay, you start hedging and start looking for the exits. Don't mistake algorithmic zero DTE activity to sustain and save this market, because it won't. It won't. So the macro data I have today, and by the way, if you want to see what it looks like on an hourly indicator, it's actually bullish. Why? Because you have to look at the market on an hourly and 2-hour indicator, okay? And I keep telling you, my model's never wrong. Never. See that? Above the zero line, trend bullish. Above the signal line, trend bullish. And it's pivoting to try to go higher and do a fully MACD cycle. It's pivoting to cycle. This is what algorithms are programmed to do. They're programmed to cycle. They cycle. That's what they do. This is trying to cycle up here, complete the cycle, and then start its way down again. That's what it's trying to do. But be very careful how you're treading here. You have no tailwinds to drive this market higher. So all you're doing is you're putting yourself on borrowed time, and you're playing with fate, which is something I do not do, because I take my fate into consideration. So the 3 macro drivers today, okay, the first one is this. Here we are. You've heard the expression, here we are, okay? What's the state of the U.S. economy? The growth is strong, but where's it coming from? One sector, AI. There's no other sector carrying the market besides AI and the chips, the semiconductors that go into the AI data centers. That's it. You remove AI and the AI chips, and the market's down 1,000 points right now. That's the only thing that keeps it. The economy's strong and the GDP is 4%. Yeah, Gianni, it is, but it comes from one sector. Absent of that one sector, every other sector has negative GDP. First things first. So don't misread. Don't look at the number, look at the components that make up the number. That's important. Number 2 is, you got low layoffs. But you got no hiring either. Nobody's hiring and nobody's laying off. So it's a stalemate. How is the economy going to get better when AI is displacing and they're not hiring people? It's not. You're being lulled into complacency here. And the third is, you've got lingering inflation, and everybody knows it. Now the Fed has given up, going, we'll just accept 3.5% inflation. And Blake has it above 4. I have it around 3.5. Whatever. We just given up. You've got lingering inflation. How do I know? Because it's a moving target. Guess what just came out? Okay, just yesterday. What data news came out? Because I don't care about opinions. Mean nothing to me in Kaufman. We don't care about opinions because everybody's got an agenda. I'm just telling you, the Fed's main gauge, the PCE deflator, that's what they pay attention to. Guess what it showed yesterday? A 2.8 handle, which is edging further away from their target. So it's a moving target. First, the Fed said for 20 years, 2%. Oh, we screwed that up because now inflation's at 7 and 8%. But we know it won't sustain. We'll just try to bring it back to 2. Well, we can't do that. Okay, now we'll just call it 2.5%. We'll readjust it upward. Okay, we'll take on more debt, readjust it upward, and everybody will pay higher prices. And the 90-10 rule of 90% of the people are suffering, 10% don't care. We'll just let that K economy grow. Now they're saying now it's at 2.8. Next week, the Fed's going to go, we got a new inflation gauge target. Our new inflation gauge target's 3%. So now that we're at 2.8, we're actually on track to keep. They're just everything. It's like Garrett says, they're just making it up as they go along. They're just making up numbers, and Wall Street's like, well, we'll key off those numbers. Reality, the reality always comes out of the shadows, and something's going to break this market one way or another. And I don't know exactly what it is because by the time it happens, it'll be too late. But all the signs are there. The market's anticlimactic. Companies are reporting, and they're not rallying. Okay, the Fed is cutting interest rates. The market can't go any higher. Like you're hitting that ceiling. Something's going to give one way or another, and I'm betting on it going down. I'm not betting on it going up. And the inflation target, Japan, they've got a problem. They're stuck between a rock and a hard place. There's no reason for you to buy this other than to buy it. You're buying it because it's overbought. And I'm telling you, algorithms are programmed to buy overbought. So you are just trading like an algo, which is fine. But what happens when the slopes change and algos start selling and you're buying? You're dead. You're never getting out. I keep telling you this because the slopes will get steeper and steeper and steeper. That's what happens. We went up in a flagpole. We went sideways. The slopes went flat. Now they're starting to turn down, and you're buying into downward slopes that haven't broken yet. The third thing I want to bring out is I call it Swiss cheese. Some of you have got to laugh at this. If I don't get a laugh out of this, I'm walking right out of the door of my office here. This is funny, people. So Trump shows up in Davos. He had to send his plane back as a mechanical error. He finally arrives there. He just steps up to the plate. He starts antagonizing all the people, which is just Trumpy. I find it funny. I find it irreverent. It excites my day. It gives me something to think about and laugh about that he goes out there and talks. But here's the part that just made me just sit there and go, listen. Trump says, quote, and I'm going to bring up if I can find it here, like word for word, because I don't want to mince words here, because he's threatening. He's threatening. Okay, here it is. President Donald Trump threatened big retaliation against European countries if they sell U.S. assets in response to his tariff threats. Now, he backed away from the tariff threats, right? He did that turnabout, that U-turn, but he still laid it out there. He's like, I'm not going to put the tariffs on you, but I'm still going to retaliate against you, okay? How are you going to stop Europe from selling assets? So let me get this straight. If all of a sudden, all the money that Europe has, trillions of dollars invested in U.S. assets, and the market drops, let's just say the market drops 5%. And Trump's like, if you sell now, I'm going to do bad things to you. Bad things. Really? Because if I'm a money manager, F you. I'm selling. I don't care about you. My job is to protect my client's assets. I got a fiduciary obligation. On the way up, protect the money. On the way down, protect the money. I'm not going to sit there and go, well, the market's starting to go down, but I'm going to worry about the president, doing a retaliation and slapping tariffs on me if I sell U.S. assets. This should not even come into the equation. Not even come into the equation. As soon as they posted this right here, immediately the market rallied. In other words, you've got retail traders trading off of rhetoric. That's going to make Kaufman like sicker than he already is. You can't trade off of rhetoric. It's the dumbest thing ever. Trade off of facts. Trade off of probabilities. Trade off of slopes. Don't trade off of agenda. Don't trade off of confirmation bias. Don't trade off of affectation and emotion. You'll never make money that way. Trade off of what you know is truth and fact. This does not impact my thinking whatsoever. But apparently, it got people going, I better buy into that dip. I'm worried about Trump. Don't worry about Trump. Worry about what's going to happen when the volatility comes back and we blow through this vol box. That's what you need to worry about. You need to play to protect. I'm sitting on 55% cash. 55% cash. I got 45% stock, and half of it is short positions. I'm not riding this down. When we have this kind of like Liberation Day, April 2nd style of waterfall, I'm going to be sitting here giggling and laughing all the way because I got so much cash. I can do whatever the hell I want. Not to mention, I got short positions that protect me all the way. I ain't losing a bit of sleep. What about you? Now, getting back to what I called the anti-climax theme. I'm going to give you 4 examples of what anti-climax looks like. The first one is, and I would appreciate a little acknowledgement, Rosario. Please validate me. That's like Lisa Simpson. Remember The Simpsons when she goes to school and she goes, please somebody evaluate me, validate me. That's Lisa Simpson. Okay. Not so intelligent. Get the pun? Intelligent off the word intel. Okay. Not so intelligent. This is Wall Street at its greatest hypocrisy and stupidity. This is Wall Street at its greatest stupidity I've ever seen. This is why Wall Street, to me, is the greatest business ever, because we have so many dumb squats in this business. You guys are just so many idiots who think they see this and they're like, oh, that's going to continue. Continue where? If Intel reports and they beat, it's already priced in. You're going to lose. It's going down $1 or $2. Guaranteed. If Intel reports in line, it's going down $4 because it's already priced in. It's a lose, lose, lose situation. You work for me. I'm out of the office. You don't sell this, you're fired. And you're not only fired, you're never going to work a day in this business. How stupid is this? It's the dumbest trade ever. They ramped it up because there's all this fake mythical rhetoric about, well, Intel's in a turnaround. Intel's a piece of crap. They blew it. Micron, Advanced Micro, NVIDIA, that's the play. This company is passe, okay? It's buggy whip. It's typewriter futures. They blew it. They're not coming back, not today or tomorrow. They're just a commoditized business that's immaturity that will survive. Here's the third piece of news, not so intelligent. And I'm referring not to Intel itself, but for those who traded it. I hope you guys get whipped. Number 3 is, if they miss, and if they guide lower, you're going to blow out. You blew out. You blew out. Look, there's no way to win. You can't win. There's no way to win no matter what they report. You're going to lose in all 3 scenarios. Congratulations, geniuses, you out there. This stock opens down 8. It should be down 18. It should go right back to 30 and sit there dead in the water. People, the earnings sucked, okay? 15 cents is nothing to brag about. They needed to report at least 35 to 45 cents, 3 times as much, number 1. The second is, who cares what the earnings are? It's the outlook that matters. Intel lowered. They lowered their outlook. How is that going to help you? Why are you buying this market? Why? Intel's telling you that the outlook for technology and semis is about peaking. Some will make it, some won't. And yet the market rallies anyways because it's a Friday, because it's OPEX, and because, well, we always buy. People, you're going to pay the piper someday for this. This is, like, to me, a classic case of money managers just don't get this business at all anymore. If you own it, you buy puts. If you own it, you sell half or get out of it. It's so ridiculously overpriced and so bubblicious and so overbought. There was nowhere for this stock but to go down. That was it. I'll see you down at 30. And I still won't buy it at 30. I'm not buying this at any price. It's a way, way overpriced stock. Okay, they blew it. They missed the whole digital age. They blew it. They missed AI. Number 2, Chinese New Year. So what's the deal? 3 companies came out today. Alibaba, and I can't lay them all out. I got to find it here somewhere. But the case of the matter is 3 major Chinese companies came out today, and they said, we are going to buy $18 to $25 billion in the first round of the NVIDIA H200 chips. So pull up NVIDIA, okay? It's up $3. It's getting play here because all these Chinese companies, okay, they tell the tech giants they want to prepare order for NVIDIA chips. That's why it's getting a lift. Now, here's what I'm telling you. I'm not telling you to sell this. I'm not telling you to buy this. This is a sacred cow. And in my world, the way I trade, I'd never short a sacred cow. Never. I've never seen anybody making money shorting a sacred cow. It just simply does not work any place, anytime. Stop shorting sacred cows. It just doesn't work, okay? I'm just telling you this. But if you want to play this, trade it. You can't invest in this anymore. It won't work. NVIDIA is done. It's played out. It's totally played out. If you go look at NVIDIA on the 5-year monthly, it's done with. The stock's finished. It might go to 205. It might go to 220. But the time of going from 187, 360, it's done with. You can forget about it. Okay. It's a fully priced company that everybody has a target on its back. My advice is don't sell it. Just trade it. If it drops 18, go and buy it, buy a call, pops 10, get out. Just trade the ranges. Do a Corey Rosenblum. Just trade the ranges. That's how you don't invest. Don't buy this. I'm going to hold it for long term. No, you're not. You're just going to trade it. It's now a trading stock. It's no longer an investing stock. Its days are numbered in terms of how long it will stay up here. But that's why it's moving. Okay. The next news I want to bring to you is this. Okay. Next one. From the current slide. Pardon me. Immaterial. Again, you have to catch my puns. They're very esoteric and very clever. Immaterial. Stock is AA, Alcoa. AA, Alcoa. I told you the market is in a topping formation. Today is useless to me, people. You're not going to change my mind, Gianni. You're not, I'm not even listening. Okay. Alcoa. It actually traded as low as about 57. Okay. The technical setup is for this stock to move a lot lower. Okay. All I'm telling you is look what Alcoa reported. Look at it yourself. Forget about me. Look at what they reported. They reported $1.26. The estimate was 85 cents. So here's a company that reported 40 cents above estimates, unlike Intel, which is a bunch of dunderheads and incompetence. They reported 40, they're 50% above, literally the estimate. And the stock got blown out $7 anyway, $6. What's the message I'm trying to send you? It's a lose-lose situation. You can't win here, people. You're not going to win this. You won't. And I'll tell you why. They beat and they still killed the stock. The stock is massively overbought, massively overbought. But the thing is, the market's all about expectations. The market sold it because the news is already priced in. Why didn't you sell it? What? Send me an email. Sell the damns. Get out of it. It doesn't matter. What they report doesn't even matter because it's already priced in. If they beat, they'll sell it off because they sold it off. They sold off 4% with a beat and a big beat. Imagine if they reported in line, it's down 10. If they miss, it's down 20. When are you guys going to get aboard? You've got to get out of these things and stop hanging around thinking they're going to rip them higher. It's a fully priced stock. Okay. 13 times earnings for this stock is a fully priced stock. It's done. When Alcoa is cheap, it trades at 5 or 6 multiple. When it's fully priced, it trades at a 14 multiple. People have been doing this 40 years. It's fully priced. It's not going up anymore. It's got to go down, compress the multiple to go up again. Again, the market's telling you there are no tailwinds. It's anticlimactic. They reported it should go higher. They beat and they crushed it. That's what anticlimactic means. The market's telling you sell. It's telling you, the market's begging you, sell me, and nobody's listening because the S&P 500 is a garbage index that it obfuscates and papers over the truth is what it does. You're not seeing the big picture here, people. Look under the hood of the car at the engine. There is none. The next one is this. All's well. Now, if you don't get this pun, I'll walk you through it. It's like oil well drilling, oil wells, get it? All's well. Now, here's a stock I sold. I sold it at 46. Why? Because I don't like to hold through earnings and the stock's massively overbought. It's way overbought. Okay. I'm out at 46. It's 50. I don't care. I'm out. I'm done. It's fully priced. I sold it before earnings because it's fully priced. I bought it for nothing. I made 32% on it almost. I clocked in here at 32. I clock out at 46. I'm done. I sell right ahead of it. But here's the point. The company reported 78 cents, 4-cent beat. And yet the stock pumped higher and now it's coming down. My assumption is this is a gravestone doji. By the end of next week, it'll be back to 45. It's just overpriced. It's not a bad company. Oil's breaking higher. So I own oil stocks. I got Devon running today. I got Oxy running up today. I own the stocks that nobody wants to own that are trying to break out of ranges. But I'm just telling you, the earnings are already priced in. Here's a stock that reported basically a good jump in earnings and they beat mildly, but it's already priced in. So if you walked in and said, uh-oh, there it goes, me be momentum, and bought it at 51, I'd fire you. You're fired. Why would you buy this here? How much higher do you think it's going to go? When companies report and they're in the hole and you want to ride through it, I got nothing to say. But when they're this overbought and this overpriced and you don't sell them, hell, every guy I know in the street would fire you. What are you doing? The idea is to buy low and sell high and get that pricing mechanism down. The reason why I sold it over here is because it was already fully priced. I don't even care what the earnings are. If they had missed, they would have probably blown it out. Always get out before earnings or hedge it. It just doesn't matter what you think, because if the chart looks like a stairway to heaven, it's already priced in the earnings. I promise you. And here, again, companies are beating and the market's not rewarding them. They're not gapping higher. That's the sign of a market top. Don't be fooled by the S&P. It's detached from these earnings reports. It's anticlimactic. Now, without further ado, I'm going to move into oscillators. We're going to do day 2 of oscillators. I'm sorry, I got to look over here and see what's happening. It is what it is today. I'm sorry, I'm just taking a look and seeing how they're buying the 52-week highs and they're selling the 52-week lows. Congratulations, geniuses. When that doesn't work anymore, what are you going to do to get out? I want my curiosity. I really want to know. Okay, so I'm just going to bring up any random stock, any old stock. So I'm going to bring up, and I don't trade it, but I'm going to bring up good old-fashioned Roblox. And I'm the guy who said at 150 it was a bubble. Too bad I didn't stay in it, but that's just not my style. So we're going to pick up on part 2 of current slide. Trigger happy, fine-tuning your oscillator adjustments part 2. So give you a Cliff Notes version, 30-second recap of yesterday. I talked about the oscillator concept. Oscillators measure momentum. They can measure volume momentum, price momentum, or price strength momentum. They can do it all. They can measure overbought. They can measure oversold. They can measure inflection points. They can measure critical resistance and support levels. They're really good at what they do. They tend to be leading indicators if you see divergences, and they tend to be confirming indicators if you see the price action be validated by the actual price action backs up the trend you're seeing. I talked about the mechanics, and in the mechanics behind them, I brought to the K period and the D period. The K period's the fast period, the D period's the slow period. But that only applies to stochastic oscillators. Stochastic involves 2 plots, 2 oscillators moving at the same time at different speeds. They're moving simultaneously, but one of them is slowed down with a smoothing factor to create like an optic where you can see when the convergences come together, it hones down and perfects your timing. Okay, that's what it comes down to. The variable adjustments you can make run the gamut. So for instance, you could change the length on the K period. You could change the length on the D period. What does the length correspond to? It corresponds to the frequency. What is the frequency? It's whatever your chart you're looking at. You're looking at a daily chart, the frequency would be a daily frequency. You're looking at a weekly chart, the frequency would be a weekly frequency. I'm looking at a 10-minute candle, then it would be the frequency of a 10-minute candle. It corresponds directly to whatever frequency you're using. So when you look at charts, there's 2 ways of looking at it. There's aggregation frequency. Let me say it again in plain English. Aggregation frequency. Aggregation's the durational period. So if I said 10 days, 2 hours, 10 days would be the aggregation, 2 hours would be the frequency. That's what we call the split or the aggregation of frequency split. You also have moving average types built into these, which create that smoothing factor inside your oscillators. Remember, some oscillators are two plots, some are 1 plot. The RSI is a single plot. The slow stochastic, the fast stochastic is a double plot. Some oscillators are bounded. Some oscillators are unbounded. This is all covered in yesterday's discussion. You can go into my personal archive on the TheoTrade site. You can click on it. There's 11 categories. This one will fall under the header oscillators, obviously, because it's categorically oscillators. So what I want to do is I want to show you how changing the variables can help adjust your entry and exits and get them to a point where you basically cut down slippage. Now, there's always a trade-off in what you do. Remember, when you adjust the variables, what you're effectively doing is, and this is like the most important thing I teach you, you're changing the sensitivity of the indicators. If you speed it up, what you're doing is you're creating more hypersensitivity. Is it bad? No. Is it good? No. Neither. It's you. What do you want to get out of it? Do you want to speed things up? Do you want to slow things down? Do you want to scalp for 30 cents? Do you want to grab $4? Okay. Your variable adjustments should be synchronized directly to your risk aversion and your holding period and the underlying volatility of what you own. Did any of you ever think that? Do you just walk in and go, oh, I'll just take the de facto default? It might work. But what happens when it doesn't work? Those things suck. Bierman sucks. I don't suck. You just don't have the right settings down. You need to sit there at times and you need to look at the settings and see it optically and compare and contrast so you can honestly see what's going on here. So let me bring this to you. Maybe Roblox isn't the best example. I need something with a little bit of volatility here, people. So maybe I'll bring in something like, and I'll just kind of like wrap my arms around this. I'm like, what has volatility in here? Let's talk about some of the insurance companies. Will Met do? Yeah, Met will do. It's swinging around. This is okay. So here's what I'm going to do. I don't have a position, so I just Jimmy Crack Corner. I don't care. Nevertheless, it provides an essential learning tool here. Just want to see something. Oh, this is just a crappy day. Crappy day on the long side, phenomenal day on the short side. I got to tell you that. Okay, so let me bring this to you. Let's just bring up the slow stochastic. Okay, and it's different than the fast stochastic, which I'll bring up to compare and contrast. So here's your slow stochastic, and you're like, I copied Bierman, and I like to use the slow stochastic. Go for it. I don't own it. It's public domain. You can use it, but here's the thing, and Don mentions this the way he trades. I could trade off of this setting and make money, and you could trade off the setting and lose money. And you're like, it doesn't work. No, it works. It doesn't work for you, but that setting works for me. That's the whole thing. Always customize and make personal settings that work for you. Screw me. Whatever I do should be of no consequence to you. It's what you want to do to make that setting work for your trading system. So in this setup, you're looking at a K period of 10-10. 10-10. That's 10 days, 10 days, and that's 10 days with a 3-day smoothing factor on a simple moving average. They smooth it out with a moving average to create that delay, which creates the orange, which is your leader, and the blue, which is your laggard. So let's identify them just for kicks. I'm like, really? Yep, let's do it. Let's call this, pardon me, T. The orange one right there. Come on. It's not doing it. What is locked up? Did I lock this up? Drawings. I don't know what's happening. Oh, I got a memory. What's this memory low crap? I got to like figure out how to get this off my screen. Is it really popping up there? Is there a memory low there? Cancel that stupid thing. All right, let's see if I can get this working again. It's not low memory, it's garbage. I don't know what's up with TD Ameritrade. So I'm going to go over here. Okay, I'll call this leader. Take me to your leader, and I'll click. There it is. That's your leader. The blue on the top side will be your laggard. So like any kind of convergence divergence in any oscillator, the leader determines the bullish or bearish trend. When it crosses underneath, it starts to take a bearish trend. So that's your leader. And then obviously the laggard will eventually catch up. The idea is you let them cycle. You change directional bias when they cross over. So the crossovers are your triggers. That's what oscillators come down to, especially whether it's a single or it's a double. This is a double. We'll also use a single. It'll take 5 days. We'll walk you through an RSI. That's that right there's a buy signal. That's a sell signal. 80's overbought, 20's oversold. So you could technically get short in an overbought and it could still keep going sideways because algos buy into strength. It's really the slope that helps you. But I'm not here to talk about slope. I'm here to talk about variables. So how can one change a variable in order to improve one's trading trigger to either increase sensitivity or decrease sensitivity and ride trades longer. When you increase sensitivity, you don't ride in the trade as long. You look for quick burst profits. When you slow down the sensitivity, you can ride the trade longer for greater profits. But at some point, okay, the idea here is you might have a lag built into your trade where you give back some of your profits because of slippage around the slowing. So here is one of the things you can do. Watch carefully. Always step in and compare and contrast. It's the best thing I've ever learned in this business. Seeing is believing. Whenever I hear things, I just don't believe it. I have to see it. See, look how these are both set exactly the same in default mode. This is what I want you to see. What if, and I play this it's a sensitivity analysis game, not scenario, but sensitivity analysis. What if I change the variables? It's basically a trigger adjustment from a 10K to a 5K. What does that even mean? I'm speeding up the sensitivity. I'm speeding up the actual algorithm built to capture and plot the momentum around and the range momentum around MetLife. That's what I'm doing. I'm cutting it in half. I'm cutting it down by 5 days, both on the K and the D period. I want you to see this for what it's worth, because a lot of you, if you made this adjustment, you could increase your profits from 15 to 20% per year. Did you know that? Well, now you know. All right. Take a look at the difference between the two of these. I'm going to bring this one up into your screen so you can see what's going on here. Okay. Oh, it's stuck right there. Okay. The crossover on the 10-10. I'm going to put on that trade. Okay. You put on that short trade on the cross underneath, right up here. Okay. That's your 10-10. That's the less sensitive. It's the slower of the two. Now let's go to the faster. Same indicator, half the speed, or rather twice the speed, pardon me, twice the speed. Look what happens here. Okay. This one technically gets overbought around the 3rd. This one technically gets overbought around the 28th. This one is 5 days faster to register overbought. Did you see that? Is it better? No. Is it worse? No. It is what it is, like a box of chocolates. It is what it is. I'm just telling you, you could make adjustments and figure out like how long you want to stay in trades or cut down lag better if you just knew how to experiment and see this. Here's one where, okay, the crossover occurs on the 16th. That's when it really goes underneath and breaks underneath. This crossover occurs also on the 16th. They just both happen to occur on the 16th. But if you can see this one, the idea here is when you create greater lag, you get less false signals. I'm going to take that trade. No, you're early. You take the trade here. You're early because it went from 78 to 83. You got burned for $6. Did you see that? I'm going to take it right there. You got burned. Going faster costs you to lose money and time. Take a look yourself. Here, if you create a greater lag, okay, you don't get overbought. You don't take the trigger as fast, but you time it better because you get less false signals. Now, let's see what would happen if I flip the script and change this to a 15. This could change. It'll freak you out. You're like, oh, how do we know? I don't know. I'm just throwing it up there to show you like what could happen if you adjust your oscillators. Because a lot of you just take it on faith. I'm going to use de facto, the default setting, and it's not helping you because it's not consistent with your trading strategy. Take a look at this one, okay? This one gave you a sell signal on the 16th. This one gives you a sell signal on the 22nd. Did you see that? This one is 6 days later into the trade. Now, if you had taken a short on either one of these indicators, you'd still made money. You just would have made less money in this one versus that one. So is this one better? Not necessarily. Why? Because this one still could have given you a head fake midway through and popped back up and locked your head off. It's hard to know. You can't predict. These don't predict. They don't predict. All they do is they identify exit and entry points based upon range-bound movements. They capture price momentum within the context of a range. And then they frame it inside a bounded like paradigm and allow you to figure out where to enter. A lot of you enter way too early. A lot of you enter way too late. If you were to adjust your oscillator and try to figure out whatever you're trading based upon a volatility, you're based upon your profitability objective on your option or stock, you might find yourself saying, well, instead of me making 28,000 this year, I made 37,000. Just minor adjustments to optimize your trading can lift your results 20 or 30% by the end of the year. It's a fact. Now, we have thousands of Theo traders. I can't sit here and have all 1,000 of you, 8,000 of you call me up and go, help me, I can't do it. Can't. You got to do it yourself. We teach you to fish. We don't fish for you. We teach you to fish. That's why I do these sessions. Go in, add your indicator, add the indicator, add the same indicator twice, tweak the variable, switch them around, move them. Okay, hone them. Let's see what happens. All I'm telling you is this one is, I want to buy right there. So you bought there. I bought at 80. Now it's 75. God dang it. Okay, look what would have happened if you didn't use the 10-10, because you would have bought right there. You wouldn't have bought at all. You wouldn't have put in one trade because you're waiting for this to bottom out and then to turn the corner and curve back up, pardon me, curve back to the upside. And you're like, oh my God, I bought way too early. I bought right there. I stepped in and I bought at 77. Oh God, help me. Please hold me. You blew it again. You blew it there. You blew it there. Twice you blew it. Know why? Because this indicator, okay, throws off false signals. Why? Because that's what they do. The idea behind the smoothing factor, which is the blue line, is to get you to slow the hell down. Slow down. If you're a position trader, sometimes taking the high road, take the long way home by Supertramp, taking the longer one averts these head fakes. You don't get caught in these false signals. I've said this time and again. There's none of you have more patience than me. I don't make more money than a lot of you. Oh, God, no. A lot of you make way more money than me. Good for you. But you ain't got my patience. I have the ability to sit here and go, head fake, head fake, head fake. I can see it in my model. I try to let the trade come to me. I am not Jimmy. Oh, God, I got money. I'm burning. Got to spend. How many trades did I put in a day? One. I sold one call spread. One. I did. That's it. Yesterday I had about 12 trades. The day before I had 0. I don't trade every day. Some days I'll put in 30 trades. Next day I put in 0. I trade when it's opportunistic. I don't trade because like I'm an ostrich on crack. Slow down. You'll make a lot more money. Go experiment with these and see for yourself. Don't trust me. Trust yourself. See for yourself. Your eyes will tell you. I teach at Loyola. I taught last night. Risk metrics last night because we're coming towards the end of we have 2 weeks, and then next Thursday, not this, but the one after, it's my weekend of hell. I have to grade 6 different papers of 30 to 50 pages. It's hellacious because they're building a hedge fund, and I have to grade top to bottom the structure of the hedge fund. I don't grade on the performance. I grade on the structure of the hedge fund and how they built it and communicate and do a presentation. The outcome is irrelevant. It's the process I grade them on. But nevertheless, I tell them, listen to me when you're in a boardroom, because I'm on the board of directors. You go in to talk to these people. A lot of them look at you like a chimp, go, and they grunt like Shaggy. I don't get this. Okay, you have to show them. If people can see it, they understand it better. It's a fact, scientific fact, that when people hear things versus when they see things, the mind works 60,000 times faster to process it, grasp it, and apply it when it can see it versus when it hears it. If I talk math to you, you're like, slow down, I don't get it. If I show you math in front of me, I get it. Of course you do. The mind thinks faster than it can hear. When people listen, they have to write it down. You have to see it, process it, it clicks immediately. Hearing is a lag. Seeing, there's no lag. You see it, you get it. So see it for yourself and see what happens here. It's like, if you just come and sometimes you're like, well, how do I know? Go incrementally. Sensitivity analysis. Change it 10, 11, 12. Do it one by one by one. Watch how it's like a slow motion time-elapse camera of what happens when these move. And you'll find like, holy crap, I trade way too fast. Slow it down. You're an intraday trader. You're like, I'm always getting that E-mini trade late with Corey. Speed it up. Speed it up. Your idea is you're trying to grab 2 points. Then speed it up. Change the stochastic to align itself with your strategy of scalping for 1 or 2 points and getting the hell out. You can't afford a lag. But if you're a position trader like me, you can afford a lag. Get the difference? This is just a slow stochastic. Let me bring something else to your attention. Okay? People ask me, what's the difference between a slow stochastic and a fast stochastic? I get this question all the time. Okay? I could sit here and I could talk to you in this highfalutin, PhD, hieroglyphic, like intimidating, okay, like language that would like, you're like, shut Bierman off. I could talk all, it's not going to help you. You can go Google it. That might help. Go Google it. Here's the best way of understanding it. Just add them. Like, why are you bugging me? Just add it and look for yourself. The reason why they call it a fast stochastic is because it's faster. The difference between the two of these is that's a 10-10. That's a 10-3. See that? 10-3. So hang on one second. I got to let out the big bull. That's my 20-pound cat, Jazz. That's the one that Don picks on me for licking himself. He was sleeping in the corner. He decided he wanted to get, when he wants to get out, you got to let he's a 20-pound cat, people. He's like the size, seriously, of a German Shepherd. He's huge. Sweet guy, though. But I digress. The difference. There's an 80-20. So the goalposts are the same. The thresholds are the same. 80 overbought and above, 20 over. And you can change them. I'll show you. We'll actually change the variables in day 5. We'll do it tomorrow. Sorry, Monday. I got 5 days to do this, so I'm not worried. So everything's the same except for one thing. The 3. What does that even mean? It means on this fast stochastic, the delayed factor is not 10 days plus 3. It's 3 days plus 3 with a simple moving average. Did you see that? Look carefully. So when you're seeing this one's approximately about 7 days faster. Is it better? No. Well, that must be worse. Nope. It's neither. It depends upon what signals you want to yield to enter or exit a trade. It just comes, it's that simple. Like a lot of you like completely, utterly, and I don't understand this. You completely overthink things. Why do you do this? Why do you think this is like OChem? It's not. Forget about all the formulas. It ain't, just look and go, you know what? I'm either going to use the fast or the slow. The fast gives more head fakes, but it catches the turns faster. You would have gotten long here on the 10-10 setting, but on the de facto setting for the fast, you would have got in a few days earlier, about 6 days early. Look, here you're getting in the 26th. Here you're getting in the 20th. Different, right? When do I get out of this trade? You're getting out right there on the 15th. On this one, you're getting out of this trade on the 5th, 10 days even earlier. So don't give me this crap like, this one's better. It's not. It gives a lot of false signals. You get whipsaw because it's more sensitive. It hugs the price action because it has a less data points. The more data points, you get this smooth factor. So the more data points are more representative and slow it down by de facto. By default, it has to slow down. These are momentum indicators that help you understand the ebb and flow of price action. They're not perfect. They make mistakes. Fundamentals can throw them a kilter. All these do is they're plotting overbought, oversold, and they're trying to yield you from when there's possible bearishes and divergences where the price action's moving one way and the oscillator's moving the other way. So you get a heads up on where to get out and not hang to the party too long. My main concern for you is that you have to find ways to squeeze out more money. So if you could add and say, man, if I had known this in my trade, I might have made $10 more to $15 more per option trade. And you're like, damn, I traded 500 option trades this year. Just add 15 times 500. What do you got? Okay, we're talking $7,500 here, people. Hello? $7,500 more, because all you did was, I watched that Bierman teaching lesson. All I did was I sped up the oscillator. I slowed it down. Believe you me, it does work. I don't always trade off the same ones. It depends upon the volatility of the underlying. Some of the underlying volatilities, I actually slow it down, and some I speed it up. It depends. The ones that I slow down are like the grindy ones. The ones that I speed up that have high vol, okay, are like the ones that make, like, more thinly traded and have greater volatility. It depends upon what you want. Some of you say, with greater volatility, I got to slow it down. For some of you, that works. For me, it doesn't. For me, the slower the grind, the more length I give it. And the faster it is, the less length I use. I actually speed it up because I'm trying to get in and out of those wild swings. Because if I let those swings go on, I'll give away profits way too much if I slow it down. It's different per person. But this is a starting point between the fast and the slow stochastic. And if you want to understand what it would be like to change the fast stochastic, you don't need to send me an email. Do it yourself. Just come on here and go, man, that K period's 10, 15. Go do a 15 and just take this up, a 15, I don't know, a 15.6. I don't know. I'm throwing it out there. I've never done it. Okay. I'll change this one, get rid of this puppy, and do a fast stochastic real quickly and leave it default and show you. That's the one I adjusted. That's the one I left alone. Check it out. Is there much of a difference? Not really. There's not much of a difference in the 10, 10, 15, 6. There isn't. So then what do? I don't know. You go the other way around it and say, I'm going to speed it up even more. So you step into the 15, 6 and go, well, what would happen if I cut this down to 5 and left it at a 3 kind of D period, and leave that smoothing factor as a simple? Check it out for yourself. Okay. Is there much of a difference? Not that much of a difference on the fast stochastic. There isn't that much of a difference. There's a little bit. The idea here is the fast stochastic is so much faster than the slow that adjusting some of the variables doesn't have a material impact. But on the slow stochastic, damn, it has a material impact. So just be aware. The only way you're going to know is to experiment. When you come in Monday, you know what we're going to do? We're going to walk into the slow stochastic and back this out. We're going to change the average type. We're going to leave the K and the D period in the de facto, change the average type, and show you how the change in the moving average from one extreme to the next can actually change the triggers. It'll freak you out. You're like, oh my God, there's all these moving parts. The moving parts of the length, the moving average type, you can mix and see what will fit. And you're like, man, I'm a Tony Rago fan, and I love trading off of a fast stochastic, or trade off a slow stochastic, tweak the model. And you're like, holy crap, I'm swinging back in and out better than I ever have. I'm getting in and out quickly without guessing, and they're matching Tony's levels. Exactly. You can actually customize this to match Rago's speed and use this to see the fluctuations of in and out movements trading futures. Did you know that? Well, now you know. I would never trade off exclusively levels like Tony does, but I would use the levels and integrate this because they back each other up and they validate each other. So we'll talk about moving average types on Monday. And then we're going to talk about goalposts, or what I call thresholds, on Tuesday. I want to get through all the different basic mechanic things that you can do to help basically get a better understanding of the application around oscillators. In the meantime, Brandon Chapman is going to run with it. He's going to run with it. I would highly advise you, and this is just me. I know a lot of you are like, it just keeps going up. Going where? Where have we gone in 3 and 4 months? We've gone nowhere. And the thing is, you need tailwinds to push us through. You don't have any. You got no Fed cut. The earnings are not very good. Companies are not responding well to earnings. Okay. And you're still hanging out at the party. This is one of those things, Brandon, where in the end, like when you hang out at a party too long, you get a really, really bad hangover. I'm advising these people, Brandon, like this party's going to end. And when it does end, don't say I didn't warn you to get out of the party early because the cops are going to come in and take you in for a hangover. What say you?
Well, I'm saying I'm in Utah, so if I hang out at the party too long, I get heartburn because there's too much sugar. We have gas stations you drive through and you can buy soda. Or just soda shacks, like they're businesses where you literally drive through and they hand you large soda.
Well,
so that's our hangover, right? It's the sugar rush, and then you get the crash.
Well, I basically skied Alta and Snowbird, okay, because I've skied those two mountains. I remember when I was in Salt Lake City, it was like on Sunday liquor stores are closed. That's what I remember.
Yeah, so like years ago, yeah. So like Utah, if you're in Utah County, especially like you couldn't sell liquor on Sundays. I was working at the time as a meat cutter, and of course, just around the corner was where the case was where they sell liquor, and people like, there's not a lot of liquor, but a lot of just like, beer and stuff. And, at least back then. And, so it's like, people are like, well, what's going on with this? It says the sign, I can't buy it. Like, I don't know. I cut meat. That's all I do.
I hear you loud and clear. All right, man. I'm going to leave this to you.
Have a good one.
Have a great weekend. By the way, Brandon, I'm looking over my screen. We got a heat wave. It's now 6 below.